Hi, I'm Hedgeye founder and CEO Keith McCullough. I'm excited to announce the Hedgeye on the Prize tournament. I challenge you to compete in this simulated investing tournament to win some serious money. We'll be awarding weekly and monthly cash prizes along with the big grand prizes. Along the way, we'll teach you how to take your investing to a whole new level. I hope you'll join us. I'll be coaching you every step of the way. I am Keith McCullough, and welcome back. I had my little half sandwich there, and I survived. All right, so thank you for joining me and Joe Calhoun. I've never had him on Hedgeye TV for any conversation, so it's a pleasure to have you, man.
Thanks, Keith. Thanks for having me on today.
I always like when we have somebody new. You're not new to the business, obviously, but new to Hedgeye TV. I want to give people an opportunity to understand both the person and the process. I think that those are two of the most important things, of course, for somebody who's building portfolios. And for those of you that don't know, he does it across asset classes, and that's why we're going to have a good discussion. But maybe just as an opening volley, like start with your process and how you approach that. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.
Well, we start with we start with strategy and tactics. So kind of defining those things. Strategy to us is an asset allocation plan. Strategy, if you think about it in military terms, and I have a military background, a strategy is the overall plan to accomplish some goal. So an asset allocation plan, a fixed allocation plan, is really kind of the basis of what we do. We call it Fortress, and it includes large cap stocks, small cap stocks, real estate investment trusts, commodities, and bonds. And we run multiple versions of that depending on risk tolerance. So it can be from 0% bonds up to 60% bonds and the most conservative. So that's the basics of what we do, that strategic allocation. And then there's tactics, which is how you fulfill that strategy. So the large cap piece, you have to decide what that large cap piece is going to be. Is it going to be S&P 500? Is it going to be EFA? What is it going to be? And so forth with all the other asset classes. And we have, the default is a basic domestic portfolio, S&P 500, Russell 2000, Dow Jones REIT Index. Usually in the commodity piece, it's split between gold and a general commodity index. And then bonds, our basic piece is the 3 to 7 year Treasury index. We want the bond portion of our portfolio to be the anchor, the thing that doesn't move a whole lot, which 3 to 7 year Treasury is kind of a compromise between the 1 to 3, which doesn't get you any yield, and the 7 to 10, which gets you more volatility. So then we do make tactical changes to that asset allocation based on what's going on in the world, what the economic environment is. This is something I hear from a lot of people, is that we're a lot like Hedgeye. And I always say thank you, but maybe Hedgeye's a lot like us. I'm not sure which way you want to put that. But we do, you guys call it the quads, we call it the matrix, but it's the same thing. It's very similar. So rising growth and rising dollar, or falling growth and rising dollar, and so forth. The difference is that we use the dollar rather than inflation. You guys tend to focus on inflation. We focus on the dollar. We think that's important for a variety of reasons. And it's really kind of a distinction without a difference, quite frankly. If you're in a falling dollar environment, you're going to see higher inflation. If you're in a rising dollar environment, you're probably going to tend to see lower inflation. So it's kind of the same thing in a way. But I think it does lead to some interesting differences, I suppose. But that's the basics of it. Really what we're trying to do is, look, we know that underlying strategic portfolio works really, really well. We've got data on that portfolio going back to 1971 or something like that. We know it performs in every environment we've had. It performed in the 70s, 80s, 90s, 2000s, and so forth. So we know that works. So our tactical changes tend to be fairly small around that strategic allocation that we know has been a winner for a very, very long time. So that's the basics of it. I mean, there's obviously a lot that goes into that and how we make those decisions and on the economic environment. But that's the basics of what we do.
Yeah, that's interesting. I mean, in the quads, distinction doesn't matter. It's actually a conversation about like how practitioners do their job. And what you find is in all four quads, I mean, there's similarities across different quads. You can just stay with the same thing. It's actual pivots to your point when you get a rate of change, particularly on the quad four, the deflation, where you have to move a little bit more, not a little bit more explicitly, because as opposed to an environment like we just had and maybe entering again in the fourth quarter, which we call quad two, that's the opposite of quad four. But back on the dollar is an interesting point too, because we use, I use the quads, but I use the signal to front run the quads, and one of the top three signals within my signal is the dollar, of course. So,
Okay.
it's an interesting one. How about that on the dollar? The dollar, if you pick a different duration, you might see something different. I look at things on a multi-duration basis, but I think most people that do what you and I do, if you said, okay, look, the dollar's going to go up 2 to 3%, commodities, they would say commodities aren't going to hit new cycle highs on that.
Well, look, the dollar, there's lots of different ways to look at the dollar too. I mean, look, The common way is to look at the dollar index, which we do, but we also look at gold and the general commodity indexes and so forth. All those things, in a sense, are a measure of the value of the dollar. In fact, if you think about it, the CPI is a measure of the value of the dollar. You're measuring purchasing power. It's the same thing. It's just a different version of it. I would say, this is what I've been saying for a while now, which is that the dollar has been in a trading range for for over 6 years now. It's roughly 90 on the bottom end of the dollar index, 100 on the top end. You had some outliers. You went up to 103, you went down to 88, but the basic range has been in that narrow range, that 10% range, for 6 years now. That historically is a very, very narrow range.
Yeah.
So trying to trade around that, the trading within that channel, it's challenging, no doubt about it, because you're right, a 2 or 3% move in the dollar oftentimes doesn't have much of an impact. Mm-hmm. But right now we're at 94 and 94.30, I think, this morning, something like that. So we're kind of in the middle of that range. We're in a short-term uptrend. That's why we have us classified right now. In fact, I think you would call it quad four, but it's short-term. We have it as falling growth and a rising dollar. And by the way, something you mentioned earlier, rate of change. Everybody wants to talk about levels, man. And I think a lot of people get this wrong, thinking about levels. It's about rate of change. It's about velocity and acceleration. It's about first and second derivative. That's what matters in markets to me. So, right now, like I said, I'm it's in a short-term uptrend, but over long-term, I'm kind of neutral in the dollar. I would love to see us get in a trend, because once it gets in a trend, it tends to stay that way. I mean, you look at these old trends, 2002 to 2008, you basically had a dollar that went down for 6 years. Yeah, some minor little interruptions, but those types of trends is what we're looking for. We want to be able to buy things based on that trend and then hold them for a long period of time. And right now, that's difficult to do. You keep bouncing from box to box.
Yeah, it's a very good point. I mean, I spent a lot of time looking at the volatility of the dollar relative to other things. So if you look at it relative to the South African rand, the rand is highly volatile, and that is in conjunction with South Africa's stock market melting down and them being economically in quad four. So there's a lot to glean from that. But more to your point, like on the longer term, I struggle with this. I mean, it's okay. Where are we going to? Because the trend's going to either go up or down. But I have it actually mathematically at neutral this morning, ironically enough. So we agree on that. But again, in the 1980s, between 1983 to 1989, or 1993 to 1999 for that matter, you had a very strong dollar and very depressed commodity prices and real strong, real economic growth in rate of change terms. Whereas in different decades, you get the opposite of that. When Bernanke devalued the dollar to I think it was 74 on the U.S. dollar index. What if it's going there? I mean, that's through MMT. That's like, how do you deal with something like that? A question like that, for me, it's not an investable. It's not a question I can answer in the portfolio today, but it is an outcome next year if the economy really slows. That if that's the political response, that I could be looking at, like a dollar. That would be a 20% decline from here on the U.S. dollar index.
Well, look, we know what normally works in those environments, right? That's why we have these boxes that we've done the research on. What do you do?
Yep.
And it is about economic growth, though. If you're in a situation where it's falling growth and a falling dollar, it's a different set of assets than you're going to see in a situation where growth is rising. The period from 2002 to 2008 was a period of falling dollar and rising growth for the most part.
Yep.
And we know what worked in that environment. Look, general commodities are going to work. Real estate worked really well. Foreign stocks work really well. because you got the wind at your back. You're making money on the currency as well. So listen, all I know is, and listen, I'm a big believer. I tell people this all the time. Look, it's not my job to predict the future. First of all, I'm not any good at it, and I don't think anybody can really do it anyway. So it's not my job. My job is to figure out the present. So I just take things as they are. So if the dollar gets in a downtrend and I can say, hey, this is something that looks sustainable on a downtrend basis, I can invest based on that. You said too, quad 4, which I think is your, falling growth and falling or rising dollar. Mm-hmm. That to me is the most difficult block, and that's where we see us right now. Now, I will tell you, I think we're close to making a change on that on the growth side, but we'll see. We need to see a little bit more evidence in the bond market to really make that call.
Yeah, that signal to me, I struggled with it or arm wrestled it throughout the month of August and September. Yeah. And I made, I think the bond market signal, and it's not just, 10-year yields breaking out of my trend signal. It's high yield spreads don't fucking move, man. They literally don't move a basis point, you know, and people are talking about contagion and Lehman. And I get the storytelling, but the high yield market's pretty smart. I mean,
listen, I think the market tells you what you need to know, and you just have to listen, and you have to a lot of times kind of block out the noise that's out there. So most of what goes on CNBC, Bloomberg, and all these places, and Twitter especially, good God, it's just noise, man. It doesn't mean anything. It's just people talking. It doesn't mean anything. I look at Evergrande. Everybody talks about Evergrande. Oh, it's this giant problem. Well, maybe it is in China. And I think that, China having based a big chunk of their growth over the last 25 years on real estate, obviously, if you start to pull back on that, it's going to have an impact on the Chinese economy. But you know what? I can look at, CDS on U.S. banks. I don't see any stress here. Is there going to be stress in some Asian bank? Well, yeah, I guess there could be. But, HSBC stopped doing financing there 3 months ago. So are they going to have some exposure? Probably. I don't know. They're kind of like the Citibank of the rest of the world. So, they're probably going to find themselves in some kind of problem. But I can't worry about that stuff if it doesn't affect the things that matter to me. Like you said, like credit spreads. Credit spreads haven't moved. Yeah. They're doing nothing. I don't see any stress there.
We have a systemic contagion risk tracker. How does that sound, Joe? I mean, it's something that Snyder might be into, right? If you pop it on, because he's into that stuff, right? The plumbing of what would get, again, it's a trivial matter to let and that includes Chinese interbank, rates. So it's like, even from that perspective, I'm going to talk to Kyle Bass next, who's clearly bearish on China, and so am I. I always say, if you're bearish on China, fucking short China. It's a very straightforward opportunity. Has been since January, February, really. Do you think that what I get in response to that, Joe, is like, well, you don't see what my research analyst sees. Like, his name is Chanos, and I got a ton of respect for Chanos, but again, you can say, and you can say to Kyle, and Kyle would say the same thing. Like, I was looking for this, and that didn't happen. That happens to all of us in this business. But right now, the thing on Evergrande that everyone thinks it could be hasn't been in terms of how you'd measure the risk. And the answer is going to be, but you just wait, Joe. You and Keith are going to get caught offside big time on that.
Well, I keep hearing that too. But you're not seeing these things. And look, Jeff is very focused on the global monetary system, and the global monetary system is a very interesting thing. There's a lot of stuff going on there, and most of it is so opaque. You have to kind of get it by inference. It's tough, man. Jeff's research has been useful to us, but it's not everything. And actually, Jeff and I have had a huge ongoing debate about what he calls a dollar shortage. And my opinion has been, and continues to be, that what we're seeing there is an effect. And Jeff insists that it's a cause. In other words, that there's a lack of dollars, and so you have these economic disruptions. My point is, I think you get the economic disruptions, and then you have the lack of dollars, because people that want to lend dollars, they want to lend it to people who are going to pay it back. And, if you've got some kind of, problem in China or in Asia, well, yeah, they might pull back and not lend dollars into those markets. But it's an effect, not a cause. Now, like I said, Jeff has a different opinion. That's fine. We're not monolithic here. Everybody doesn't agree on everything. Yeah. But, I think that Jeff's research is extraordinarily important because it reveals things that I wouldn't see otherwise. Yep. And so that's interesting to me. And most of it, listen, what I say is all these things that we talk about, they end up getting expressed in the market that everybody sees. You'll see it in the dollar, you'll see it in the yuan, you'll see it in credit spreads, you'll see it somewhere. You're going to see it. And if you're not seeing it in those places, then whatever stress there is not big enough to really cause any kind of big disruption. And I think that's where we are right now. Look, maybe it does turn into something big. I don't know.
Well, I've done we have 80 people here, and all we do is research. So you would probably go batshit crazy in here with a lot of the different things people come up with. But again, there are a lot of structural, longer-term things, like what we'll call pillars of economic risk, is what we call them. What the back test says is that unless you're in a growth slowing environment, particularly quad 4, those things don't matter. And that includes things like debt, deficits, lying governments, communists. Put anything in there, and that's you got to have a healthy respect for that. I think that you either you gotta lose your hair like you, or you gotta go completely gray like mine is going. It's like you have to have reps in market return terms to respect that fact, and not just say, okay, look, this guy really sounded interesting, therefore I'm going to change my whole portfolio because of what he just said. I mean, to me, that doesn't fly here at Hedgeye. We have a lot of arguments with each other because that's how we roll, and it's healthy.
I think it absolutely is. And look, I always, this is another thing I really don't like about the way things get presented, for instance, on Twitter and various other places. It's what I call all or nothing investing. This thesis, I'm going to bet my entire net worth on this thesis. It's like, I'm sorry, guys, that's not the way to invest, especially if you're an average person trying to save for retirement. You can't do that. Because if you're wrong, you have just screwed things up, for a long time, and it takes a while to recover. There's also the matter of if you're wrong, it's really hard to admit you're wrong. And so you end up sitting in this position for a long, long time, and before you finally throw in the towel. So I don't practice all or nothing investing. It's always about nuance. We want to shift. We want to overweight something or underweight something. And so that's the way we go about things. People have this idea that, Jeff's bearish, so we're going to sell everything. And that's just not the way we work. And I don't think it's the way, anybody should work with running a portfolio.
No, I mean, imagine my long-short positioning since, partnering with Neil Howe, who wrote The Fourth Turning, was only the fourth turning. Every day I get up, I sell a newsletter based on scaring the shit out of people about what sounds pretty scary. Fourth turning sounds pretty scary. It is, and it's happening, it's going to happen, but that's just not how we work. I mean, we educate ourselves around all the different things that we don't know, which is manifest. What I love, by the way, about, I hadn't read anything that you'd ever written until I was preparing for this. Nobody that's been at this investing summit has used the 3 words, I don't know, more than this guy. Not one. Not even close.
Well, yeah, look, there's a lot I don't know. I mean, I think people in this business, they get afraid of saying they don't know. But look, there's things I don't know. Look, I think right now is a great example in this debate where everybody's kind of having about growth, right? Okay, I've seen, I think we did a great job. Jeff and I both kind of called the top on rates at 175. I made a comment that I thought if the 10-year fell to 120, it would still be in an uptrend. And it did, and it is. But, you get a drop from 175 to 115 on the low end, and, it had a cup of coffee at 115, call it 120. So you drop 50 basis points, whatever it is. And now we've gone back up 30 basis points. Look, these are pretty small moves, but you know what? All I did was respond to what was happening. I didn't predict anything. I don't know what was going to happen. I just said, hey, rates are going down. And rates going down has a very definite meaning. Mm-hmm. And rates going up has a very definite meaning. So, look, we can't say, you can't cherry pick, right? You can't say, hey, rates are going down, so the economy or growth expectations are falling. And then rates turn back up and you go, well, that doesn't mean anything. Well, no, it means just the opposite.
Yeah.
So this debate we're having right now about growth, okay, I hear you've kind of made the call and said that we're in a rising growth environment. I'm close to making that call too, but I haven't because I just think that I'd like to see a little bit more upside in the 10-year first. I think it is, short-term trend is obviously up. The trend over the last year is up, really since last August is up. So it is in that sense a rising growth environment. But look, there's a lot of things we don't know here. We're
Yeah.
running kind of a live experiment in the labor market right now. We just ended
Yeah.
these extended and expanded unemployment benefits. How are those people going to respond? Are they actually going to go out and get jobs? Were some of them never planning to go back to get jobs? I don't know. We got an ADP report this morning that was fairly positive, but 500 and something thousand is actually, I think, less than the monthly average for this year. I think the monthly average this year is around 700.
Yeah.
So, if you how is this going to come out? And I think longer term, there's questions about that. Look, our base case for the economy is that we came into COVID growing at roughly 2.2% over the last 10 years. Okay. So we go through COVID, we add a lot of debt, and I don't think we did anything that makes us more productive. And so if we didn't do something that makes us more productive, I think if you add a lot of debt to an economy that was growing at 2.2, when you finally settle all this out from COVID, you're going to be growing at something less than 2.2. That's kind of my base case. Now, is it 2? Is it 1.8? I don't know. It is what it is. It'll come out somewhat less. But there's wild cards there. I don't know. Mm-hmm. How is the economy changing because of COVID? And there's things we don't know about. Again, look at the participation rate. Is the participation rate going to go back up? I don't have an answer for that. It may not.
Yeah.
There's
a lot of what you don't know. You just did it again to me. You just now you're saying what you wrote. It's like, I think that's, most people should take great humility in what you just did. And I wonder if it's because, it's largely because who you are. Let's just start with that. My dad was a firefighter. You said you spoke of your military background. If I don't read and react, you tell me this on the ice. You tell me that if people die in his profession if you don't have an ability to read and react to changing conditions and realize that the situation is totally nonlinear, full of the unexpected. And I wonder if it's just who we are, because what I see are a lot of, clearly people that are a lot more intelligent than I am in this business. I'm not an intellect, but people that are, they don't have that same background or principle orientation, do they?
Well, I don't know. Listen, I don't want to speak about other people, man. I don't know what they're doing. I don't know why they're so sure of themselves. I really can't give you an answer for that. But I can tell you this. My military background was on submarines. We had a procedure for everything. We had a procedure for flushing the toilet. Okay. And you had to follow the procedure. Yeah. But you also had to be flexible enough to think on your feet when things go wrong.
Yep.
Otherwise, 120 people die. So that's my background. That's where I come from. Mm-hmm. I like I said, I can't speak for other people. I just know I can't predict the future. That's the big thing about this business. Everybody wants to say that. And I've told people this, look, if your investment process, if the first step is reliant on your forecasting ability, you're in trouble from the get-go.
Right. It's what you said about all or none investing. And there's macro tourism, which we can get into, which is the CNBC, the Twitter part. But the all or none, like the incentives on all or none, Joe, are huge. I know people that have worked in the hedge fund business for quite literally 3 to 5 years, are worth $100 million or more. All they had to do is make one big call. They didn't have to show that they have a repeatable process across cycles till they're 6 feet under or on the wrong side of the grass. That's what you and I have to do. It's actually a pretty challenging thing to do. But it is easier, I think, and more accessible for people to come up with a milkshake theory over here or this over there. And if I get that right, then they can make a lot of money in a short period of time. But that's not, you and I, it sounds like we don't have those goals.
Look, I'm blocking and tackling, man. Look, I'm trying to work for people here. Our client base is pretty conservative. Awesome. They're people. They're just regular folks, man. They've saved their money. They've done the right things, and they're trying to make sure they don't screw this up. And as they're going into retirement, a lot of times, the vast majority of our clients are either pre-retirees in their late 40s and their 50s, or retirees, they've already retired. To me, what those people need, and I think people are starting to get this, what they need is consistency.
Yeah,
it's not about knocking the ball, out of the park on a daily basis. It's not about having big years. It's about consistently knocking out that return every year so that you can draw the money out of your portfolio that you need without worrying about running out of money. Mm-hmm. So consistency, and I preach this all the time. This is what we're aiming for, is consistency. And I think that's the unique thing about our approach, about our strategic approach, is it has been very consistent. But you know what? It's never the best performing thing. It's also never the worst performing thing. So I want that consistency, and I think that's what our clients want, and that's what we aim for, which means you don't make big bets.
Mm-hmm. Well, I mean, that's a big part of what we walk through. Like every day that I can try to coach it, portfolio construction. What I realized with Hedgeye, because I spent most of my career on the buy side and then started building this out, and what I realized were like some really basic things, like real basic things, like a firefighter having his helmet on. Like you cannot, like I was almost shocked at how people were like, wow, you have like max allocations on fixed income that are higher than your max allocation on equities, and your equities are higher than your commodities, and you volatility adjust them? Wow. And I was like, wow, why? Like, what is the, again, talking about other people doesn't really matter. It's doing what we do is what matters, which is you're coaching and educating your clients all the time, I assume. I got it. I'm just like, it's almost like I'm asking, I'm usually the shrink. Can you be mine? Like, what advice would you give to me that you've been talking to clients and coaching them through or de-stressing them for your whole, the whole build out of your firm? Like, what do you think are some of the best tactics in terms of training or dragging or coaching, in my case, subscribers and your clients?
Well, I think that the thing is people need to figure out what their time frame is. When I look at you guys versus us, and what I see, publicly from you guys is more trading oriented. But I know you guys have a long-term orientation too for subscribers. It's not all trading. So I think people need to understand that there's a difference between that short-term and long-term, and you got to decide what you want to do. And look, the trading portion of it is going to be more volatile. It's just the nature of the beast. I mean, it's the way it is.
Yep.
And I think too, the thing that here's a great analogy. I always tell people, look, don't worry about your batting average. I'm a baseball fan. I played baseball in college at Carolina. I love baseball. So I always use this analogy. Investing success is not about batting average. It's about slugging percentage.
Yep.
It's about how much you make when you're right, how much you lose when you're wrong. Now, that describes investing, but it really describes trading. If you're going to be a trader on a short-term basis, you better be willing to admit a mistake. And by the way, you don't have to be right a whole bunch to make a lot of money. You can be right 55% of the time, even 50% of the time, and still turn a great profit as a trader. The thing that's interesting about traders, and I come from a trading background too, the thing that's interesting about traders is their ability to get rid of the ego. And listen, I've been doing this for 30 years, man. I don't have an ego left, man. I got beat up at all kinds of times in 30 years, man. I spent 1999 trying to short Yahoo, for God's sakes. Give me a break. There's not a whole lot that's going to come along that's really going to, scare me at this point. But I think that's what I would say with you guys. I think I look at what you guys do, and I find it very interesting. You guys are obviously very successful. I just think that maybe, the trading oriented part, I think needs to be, hey, this is trading and this is investing. And I know you guys probably do a great job at that anyway. I certainly don't want to tell you how to
I don't think, I always think that, there's being a player in the game and then there's being a player coach. Again, until I'm on the wrong side of the grass, I got work to do as a coach. I can go to which I do, after the macro show, which is the shorter term stuff, and I go to my desk and I'll sit there for an hour and a half and say 0 words to any human being at Hedgeye. There's no loudness.
People think that we're always at our desk doing things. I'm at my desk reading most of the time, Look, there's a lot of information to absorb. And again, a lot of it's just junk stuff. You don't even need it, but you got to scan it at least to figure out if it's junk.
Yeah.
So same way, man. I like I said, I think about all day about what to do with these portfolios. Another one of my little favorite sayings. Listen, I'm a Southerner, so I've got sayings, I've got stories, man. That's what us Southerners do, right? So
us Northerners from Canada have stories too, man.
Yeah, you do actually. Well, you guys come to South Florida and take over the beach at certain times of year, but I'm not in South Florida anymore, so I don't know if you know that. But anyway, I always say, look, the answer to the question, what should I do to my portfolio today, is almost always nothing.
Yeah.
Almost always nothing. If you're an investor, now a trader is a different story. A trader, you could be doing stuff by the hour, but somebody who's investing for the long term, most of the times you just need to sit still.
Yeah, I agree with that. I trade obviously, and but I'm also like, finally in the last couple of years, you got to stay on the full investing cycle. If you could, you would. If you could sell, whether you call it Joe's Matrix or you call it my quads, if you could sell the top of every growth cycle and buy the bottom of every growth cycle, your name won't be Joe or Keith, it'll be Bernie Madoff, because nobody's ever done that, okay? But if you could, you would. You'd be long commodities for the full inflation cycle. So that's a good example. It's like,
but think about what happens during a cycle, though, right? You have multiple times where you have growth rate slowdowns and growth rate speed ups. It happens throughout the cycle.
Yep.
And I would just say that, listen, I get defensive when we have growth rate cycle slowdowns, because that's when you're most vulnerable.
Exactly.
Obviously, if you slow from 2 to 1, then you're closer to recession. That's when you're going to be more defensive. But you can't. If you try to play all those cycles, you're not going to get them all right.
What's interesting about that, if you just look at what just happened in rate of change terms in the U.S. economy, is just that. I mean, slide 13, guys. The rate of change of U.S. economic growth, the prior cycle peak was 3.3%. During the pandemic, it was -8, -9. It goes to up 12.2. If you didn't know that we were going to have an acceleration off the pandemic low, you missed a massive growth cycle. Then the growth rate got cut in half in the most recent quarter. And now it's a horse race. This is why guys like Joe, I'm saying I'm going for a reacceleration in the fourth quarter. He's saying he might. But it's still nothingness, Joe. It's like 6% GDP. I'm not about the level. I mean, if it goes from where we are, which is less than 6%, to something more than 6%, that's an acceleration. And if people are willing to miss that, they're willing to miss that. But they don't really have to make a move. Nothingness is also a position.
Well, there's also the idea, too, obviously, that the slowdown already happened.
Yeah, that's what I mean. That's
quarter three, Atlanta GDP now is, I don't know, 1.5 or something like that. I don't think it's going to be quite that low, but I don't freaking know. It's going to be somewhere lower than 6.5 or 6.7 in the second quarter.
Yeah.
How much lower? I don't know. It doesn't matter. Interest rates went down. They told you it was happening. All you had to do was acknowledge it.
Yeah.
And now rates have turned and started to go back up. It looks like things are improving. And I would just say, too, I've heard a lot of people say recently, over these last couple of weeks with rates going up, oh, well, that's about inflation fears. But I got to tell you, I look at tips too, and tips yields have been going up just like nominal yields.
Yeah.
To me, what's happening right now is a growth impulse, not an inflation impulse. So a big distinction. You got to look at both. You have to look at real rates.
When you have real growth slowing because inflation's accelerating too fast and it's eating into real growth, that's what we just came from. That was our call from end of June until most recently. But that's, in that case, things like gold will go up, utilities will go up, consumer staples will go up. What people should have noticed, day to day, it is important to look at the pulse of the market and what factors are moving. Those things are going straight down with the market. They're not going up with the market. So it's a very interesting setup. I do think that it's back to I think you called it the cacophony of CNBC or whatever. These people, they're all parroting the same thing. It's on the frickin' cover of Barron's, for God's sakes, the bottleneck. But that's Q3. What is it? Maybe there's a question in there, which is, do you have to have you trained your dragons, or what percentage of your clients do you have to walk off the plank on what they read on Zero Edge or Twitter each day?
Well, look, actually, we don't get a lot of calls like that. I think we do a pretty good job of explaining what we're doing and why we're doing it. We have things that go out to clients that don't necessarily go out to the general public. But look, we do have that situation sometimes where people, ask us about certain things and they think, oh, this is going to cause a problem or whatever. But look, Zero Hedge and all these places, they're trying to get clicks. They're trying to make a living too. And you don't get clicks by saying nothing's going on. So, something's got to be going on. I mean, look at the third quarter we just had. S&P was up 0.58% in the quarter. REITs were down less than 1%. EFA was down less than 1%. The only thing actually that significantly moved in the third quarter was commodities. That's it. Everything else was flat. Gold was flat.
Yeah.
So, and I keep looking at gold too. And we get a lot of people that come to us and they think they want to own gold. I don't want to call them gold bugs. People have their own personal reasons for owning gold, whatever it is.
Yep.
But I'm like, you know what? To me, I'll own some portion of gold long term for my strategic allocation, but on a short term tactical basis, I'm sorry, gold peaked in August of last year. Mm-hmm. If you're sitting there waiting for that to turn back up, you've just wasted a year. You could have been doing something else.
Yeah, that was the end of quad 3. That's when mega cap tech peaked. Anything big cap, liquid, gold. That was a real growth environment that hadn't yet accelerated. But by the fourth quarter, it obviously accelerated big time. Just one other question on that, and then I'll take some of these questions. You're on Twitter, right? Is that incorporated into your process, reading other people's tweets or not?
Yeah, I would call myself a lurker. I read a ton of stuff. I'd read a ton of stuff on Twitter. I don't write a lot on Twitter. I'm there to observe. I make my little snide comments occasionally because I can't help myself sometimes. But in general, I just want to see what everybody. Listen, that's part of the process, right?
Yeah.
I've talked about this a million times with clients and other people, and I'm sure you're familiar with the story of Kane's beauty contest. You know that story, Kane's beauty contest?
I don't.
Okay. So John Maynard Keynes, obviously, everybody knows who John Maynard Keynes is. He was also an investor. He was a very successful investor. And he talked about the stock market. He said it's like a beauty contest that a newspaper has. Newspaper puts 100 pictures of women in the newspaper, and the winner of the contest is the one who chooses the woman who is deemed to be the most beautiful. Now, think about how that's worded. It's not the one that you think is most beautiful. So you have to figure out which one everybody else is going to think is the most beautiful. which one is the majority going to think is the most beautiful. Yeah. So you're not trying to, and I always say, look, this is not blackjack. This is poker. You got to play the player.
Yeah.
So knowing what everybody else is thinking and what they're acting on is absolutely essential to figuring out what you're going to do with your portfolio. You got to know what the world's thinking about.
You know what's interesting on that front, guys, if you show it, this is the most recent net positioning. This is, to me, like the poker table. People can tell me people are bullish or bearish. I'll just say bullshit if it doesn't fit what the positioning of the market is. Now, the positioning of the market, albeit a lot less than it was, I shouldn't say a lot, it's on natural gas. At the end of the second quarter, to your point, Joe, it was the only thing. Now we're seeing outliers. We're seeing people, obviously, shorting a lot of currencies have gone down and chasing things like cotton that have gone vertical. So I put a red arrow there because now people are as net long of cotton as they've been in 3 years. But it was the biggest net short position in all of global macro.
We've been talking about this for months.
Ended up being the number one thing you could have owned in global macro in the third quarter. And that's
listen, I've been writing about this for months. Natural gas is in an uptrend, and the large specs are still short.
Yep.
And they're still short today, even after this move. They're still short. And now look, ours, we don't trade futures, so it's a little bit different for us. So there are only limited ways you can play a rise in natural gas. From a stock perspective, there's not many pure plays in gas. There's a few, but not many. And there's a couple of ETFs that trade natural gas, but they're not real efficient. But they are what they are. But we caught some of that too. Look, the thing with natural gas to me was just, I started looking at this over a year ago from a fundamental standpoint and thinking that, look, shale shuts down. You just shut down a huge chunk of gas supply.
Yeah.
And we know that gas demand is going to continue to rise because we're killing all the coal plants. We're shutting down nuclear plants, and gas and solar and wind, as nice as it is for the environment, I suppose. I don't know all the particulars on that, to be honest with you. Obviously you were going to use more natural gas. So it was not rocket science to say, hey, we've got shrinking supply and increasing demand, that price is going to go up. And I think if you get any kind of correction here, it's probably going to go higher still. So
yeah. We're getting a correction today for those of you for those dirty little traders out there. While Joe is lurking on Twitter, I'm trading. It's like.
Well, listen, I'm looking at the market. I saw natural gas. Well, it's kind of funny, actually, right? I mean, you get some comment out of Russia about natural gas in Europe, and natural gas goes down in the United States. I'm like, people do not understand this market.
No,
natural gas in the United States is mostly a local market. Yeah, it's somewhat global because of LNG, but really it's a local market. And the same thing in Europe. It's kind of localized to Europe. So something happens in Europe with natural gas doesn't necessarily mean anything to the United States. But and that's the difference between what people think and what the reality is. Listen, here's the way I would classify Jeff and me. Actually, I'll tell you this. Jeff's job is to describe reality as closely as he possibly can. Here's how things are. My job is to judge what everybody thinks things are. And when there's a big gap between the two, there's an opportunity.
That's a great way to distinguish the analyst versus the portfolio manager. Like if people see me trump part of the pundit, the analysts at Hedgeye all the time, like on their view, because the signal just doesn't agree with it. We're not in the right economic quad, so I just won't go with it. And over time, it may not work. It doesn't work 100% of the time, but it works more than it doesn't work, to Joe's point, which is, by the way, if you want to be one of the greatest hedge fund managers of all time, provided that you don't have drawdowns, I mean, being right 2/3 of the time will make you an all-star perennially.
Not even 2/3.
Yeah.
Make it 55. It's fine.
Yeah, exactly. Here's just a couple questions here before we let you go. First question, Daniel from Connecticut, which is an open-ended question. Joe, what's the biggest risk you see that nobody's talking about?
Biggest risk I see that nobody's talking about. I'm not sure I have an answer for that. I think the things I worry about on a daily basis is the dollar. If the dollar gets in a rapid uptrend here, you could have a problem. China doesn't worry me all that much. I'm old, so I remember Japan blowing up in the 90s, and it was the second biggest economy at the time, and it blew up, and there really wasn't all that much blowback to the rest of the world. I'm not saying China's exactly the same, but I don't know it's that much different. I don't really see anything out there right now that really worries me a whole bunch. I would say this: I think that that markets have moved to some extremes, and I think one of the things I always talk about reversion to trend. Mm-hmm. People talk about reversion to mean. I look at reversion to trend. Mm-hmm. So things get way far above their long-term trend. They're going to come back to the trend, and there's some things out there right now that I think are way above their trends. And so those things are probably going to come in some. But the dollar is the thing I think that would key me the most. If you get a rapidly rising dollar, it means you've got some kind of change in the global plumbing that's causing people to rush to dollars. That could be a warning sign.
Yeah, I agree with that 100%. There's no way that I would never agree with that 100%. Dave in California, question which you've already mentioned, you alluded to it, but I think he wants more specificity. Joe, what would it take for you to shift your view to the path of pro growth?
I just need to see, I think I need to see the 10-year move stay in this trend. We've moved up to this level around 155 a couple of times, 155, 157, and we can't seem to get through that. I'd like to see us move through that. I think there's a lot of things kind of holding it back here. There's worries about the debt ceiling and worries about Evergrande and worries about all these other things. So I think people are focusing on the negative right now. And I find it very interesting that rates have continued to go up, even though that's true. I just want to see a little bit more upside to the 10-year, and I'd like to see real rates in particular. Look, the 10-year tip's still minus 90 basis points. I'd like to see that improve. Negative 90 basis points on a real yield is just ugly, man. It doesn't say anything good about the economy. So I want to see that move in the right direction.
I was remodeling my what I define mathematically as trend, and I'm using price, volume, and volatility for that. The German 10-year yield against the UK 10-year yield this morning, and it's like if these things go up like back to the trend, pre-pandemic trend, I mean, you're talking about a hell of a move in nominal rates. I mean, and that will definitely impact what tips think or what real rates are doing. So that's an interesting. I think it's interesting to watch. To your point this morning, like I got up this morning, I get up on European time, unfortunately, which means that I won't be on the right side of the grass for as long as many, because it's a stressful job. You got to do it. You got to do it every day. And I was like, really? European equity markets opened down 2% on August? August. Factory order numbers out of Germany? I mean, it's October. I mean, it's crazy.
Well, look, I talk about this all the time too, man. And I had a piece I wrote not long ago about these economic reports. Look, most of them don't mean a thing. Look at we're getting an employment report on Friday. What's the plus minus on the accuracy on that thing? Plus 100,000? Plus or minus 100,000? Look, I wrote about this not long ago. I remember August of 2011, and I'm pretty sure it was 2011. We had an employment report, and it was obviously in September because it was the August report, and the expectation was like 125,000. The thing comes out negative, like a minus 40,000 or something. And the market just tanks, bonds rally. Everybody's like, oh my God, we're going into we double dip recession. I mean, I think that was everybody's shouting it from the mountaintops. Well, by the time the thing finally gets its final revision 2 years later, yeah, it's plus 125.
Yeah.
So
no, the standard. It's actually the standard error We when you have an army of analysts, you can measure and map the time series and rates of change of everything because you have the time, and you need the bandwidth. But I mean, the hardest thing, because it's got the highest standard error, is the non-farm payroll report. By a country mile, it's the hardest thing. And what's amazing is that these clowns at CNBC, they make the whole morning about guessing the number. I mean, it quite literally is a guess. It's not. There's no analytical process associated with that.
It's actually, I'm from the military, so it's a WAG. That's what that is. That's a wild ass guess.
A WAG.
A WAG. It's a WAG, man. Nobody knows what the hell this number is going to be.
Yeah, it's a WAG.
Look, I'll give you another example too of one that I think people concentrate on, and I think is just kind of ridiculous. And I would just say this: I think people need to figure out context. They need to put these things in context. Here's an example. We got jobless claims, weekly jobless claims running at 350 right now. And everybody's like, oh, it's ticked up over the last few weeks. Oh my God, this is terrible. Things are going the wrong direction. Here's a question for you. How many times did we print less than 300,000 weekly jobless claims in the 90s? Yeah, the answer I think is like one. 330 to 350 during the 90s, which is a time everybody would agree was very good economically, especially the second half. 300,000 and 350,000 in unemployment claims on a weekly basis was normal. And by the way, same thing from 2000 to 2010 or 2008. We never got down to where we did pre-COVID. Everybody's comparing back to pre-COVID and saying, hey, we were down at 220 or whatever it was. And that's where we ought to be going. And if we don't go there, we've got a big problem.
Yeah,
we didn't have a big problem in the 90s.
No, it's like back to a word you used. In addition to, I don't know, consistency in your process and making sure clients understand that. Like the consistency of the labor market and labor market gains and rate of change terms is what's clearly going to matter. There's actually a lot of bean counting that would put that Friday number on the other side of the ADP number and the October number be a much bigger number. There's some dynamics around the 12th of the month and expiring benefits and all these different things. But again, that's my analyst doing the plumbing, and I don't know if he's right or wrong on that, but the bond market is basic. I think the bond market's saying whether it's this payroll number or the next one or both, that's going to be a big thing for you because that's going to move the 10.
I think it is. Yeah. Well, listen, I've kind of thought the same thing. I don't know that this month is going to tell you much, but next month I think you really start to get a better look at this. Yeah. Look, Goldman had some research out. Not that I pay a lot of attention to Goldman or any sell side.
Well,
really.
on this topic, Hotsius' team's done the work. They're good on
it. Pretty good, yeah. They had this thing out saying that, look, the end of these unemployment benefits was going to mean an extra 300,000 jobs a month for the rest of the year. Well, that's true. We could be printing 1 million jobs a month for October, November, December. That would be a big deal.
Yeah, it'd be a big deal for the labor market. It'd be a big deal for the Fed. All right, man. Well, I love it, man. You gave us the WAG. You gave us the lurking. You gave us But what I really wanted to get was to get to know you and get people to know your process, and I think we achieved that. So thanks for just being uniquely honest about this business. A lot more people should do that.
I appreciate that, man. Thanks for having me on.
Yeah, you bet. He's a beauty, that guy. The WAG. Up next, I'm gonna go with a guy who's not wagging, Kyle Bass.